Well, if you're in a hurry, go ahead and pause your screen right now. These are the 5 dividend stocks that have a Simply Safe dividend score of safe, and they are currently all under $47.03. But if you'd like to learn a little bit more and have some context, then stick around. Hey, yo, what's up? I'm Russ, and this is Dapper Dividends. We got the portfolio updated. I'm now combining all 3 of the portfolios we share and talk about. So if you want to see what's inside of those, head on over to dapperdividends.com and click on my portfolio. So instead of just picking 5 stocks that are cheap and sharing them with you, I instead picked out 5 that are currently under $47.03 and have a Simply Safe dividend score of safe or better. And with that, let's get into them. First up, we've got Keurig Dr. Pepper, ticker KDP. I think everybody kind of knows what they do. Check it out. They are the 8th largest food and beverage company in the United States. Let's take a look at their brands. And because of their merger with Keurig, they have a whole bunch of different coffees on the roster, ton of them, flavored soft drinks that everybody knows and loves and we're all familiar with, except Cactus Cooler. What the hell is Cactus Cooler? Teas, waters, juices, juice drinks, mixers, and more. So they currently do have a dividend safety score of 70 with that yield at 1.99%. Their last dividend growth was 25% in May of 2021. In March of 2021, they upgraded them from borderline safe to safe, because they are paying down their debt. And this is pretty cool from the merger presentation. It gives a breakdown of exactly where all the products in their portfolio came from and who they are partnered with, such as Starbucks, ticker SBUX. So is... It's going to be like that again, buddy, huh? They had a little bit of dividend cutting going on right before the merger, so it's a little bit of a different company afterward, currently paying out 18.75 cents per share per year. And this guy just messes me up, man. Where were we? A little bit toward the high end of the 52-week price range. And they are indeed a little bit below their 5-year average of the dividend yield. I always like looking at the payout ratio, 42% free cash flow payout ratio. Their sales have been steadily increasing, which is nice, but they've also been increasing their shares outstanding, so a little bit of dilution with the shareholders. Not great return on invested capital at 7%, but again, they do have really nice free cash flow margins. Not a lot of debt, and I would like to see that interest coverage ratio a little bit higher than 6.19, which is, what? $6.19 of operating income to cover every $1 of interest expense. And according to Alpha Spread's intrinsic value, Keurig Dr. Pepper is about fairly valued. Next up is ticker T, AT&T. Man, I've done a lot about AT&T, as you that follow the channel know. Just a plethora of videos. I like what they're doing. I think it's fantastic that they are going to be leaner and meaner. There was not that much synergy with Warner Media, so good thing I think that they're putting them off by themselves and they can focus on what makes them their bread and butter, which is the wireless and their internet, the fiber. Now, of course, AT&T did right-size that dividend, but it's still a cut after spinning off Warner Media. Currently has a dividend safety score of 70, which is safe. Now, that yield is 4.6%, but after they divest themselves fully of Warner Brothers Discovery, Warner Brothers Discovery, that yield should be somewhere about 6%, paying $1.11 per share per year. And there it is, the upgrade on March 29th, 2022 from unsafe, because it's already after the cut, to now 70. They believe their dividend is safe. So you do see that cut reflected here, went from 52 cents a share per quarter to 27.75 cents. And a lot of these numbers are going to change because this is still not reflecting post-spinoff, but they were at a 59% free cash flow payout ratio, but they believe that they're going to be targeting 40 to 43%, I believe it was. So that's where we're going to leave it with AT&T, and much more to come on them in the coming months. And it's hard to tell if this is post-spinoff or not, but Alpha Spread's intrinsic value currently is about 49% above where AT&T is right now. Next up is a company that was in the news news recently because it was announced that Warren Buffett's Berkshire Hathaway acquired about 121 million shares of the PC and printer company, which is Hewlett-Packard, now known as HP. And check out how Hewlett-Packard's stock shot up 15% after the announcement was made, which made Warren Buffett about an extra $650 million after the big reveal. HP's in the tech field, of course, as we said, with laptops, desktops, Chromebooks, printers is what we know them for, and just a bevy of computer and tech related hardware and storage items. Simply Safe Dividends has a dividend safety score of 74, which is safe. Current yield of 2.59%, which did come down a little bit after that announcement was made, because remember, when the share price goes up, the dividend yield goes down, and when share price goes down, the dividend yield goes up, which is why we like to buy when share prices are down, because we're getting more bang for our buck as dividend growth investors. Their last dividend increase was 29% in October of 2021. Check it out, 5 years of dividend growth streak. They had a cut there from 2015 into 2016, but they have been increasing it ever since. So the current yield is about 9% below the 5-year average of 2.83%, as well as the PE ratio, though, is just slightly under the 5-year average. And thanks to Warren Buffett, the 52-week range, it's toward the higher end of that 52-week range, but their PE is only 9.1 compared to 18.7 for the infotech sector. Really solid free cash flow payout ratio at 15%. Sales growth has recovered a little bit since the pandemic sell-off, currently about 12%. They've been buying back shares all the way down to 1.17 billion shares. Their sales have been kind of floundering and chopping sideways a little bit, but look at the return on invested capital, 95%. That is just incredible management to have a 95% return on invested capital. According to Simply Safe Dividends here, we see they virtually have no debt, so that would need to be double checked and verified, and a 23.04 ICR. And according to Alpha Spread, HP is about 32% below their intrinsic value. So this next company I first heard about from PPC Ian, and it is PPL, where PPL is an electric utility company. PPL stands for Pittsburgh Power and Light, and they also have utilities in Louisville. I've been there. It's not Louisville, as I was convinced and told my whole life. It's Louisville and Kentucky Utilities. PPL does have a dividend safety score of safe, which is 80. Well, how can that be? They just cut their dividend 52%. Well, that's because they divested themselves of their UK utility operations, as we see here, that they were upgraded from unsafe to safe in March of 2022. Now, their current yield of 2.75 is about 51% below the 5-year average, but management expects that they're going to eventually be back to about a 60 to 65% payout ratio, and probably as soon as this summer, they would say we should expect a dividend increase. So that should revert to the mean and get closer to that 5% yield. And they don't move a lot. The 52-week range is only $25 to $30, so they're at the higher end of that range. And PPL's PE that I first heard about from PPC Ian is currently 19.7, which is about 21.5 below the utilities sector average. Free cash flow payout ratio is 426%, which we can't look at that for utilities because they're so capital intensive that they have to plow so much money into their projects. So it's better to look at the earnings per share payout ratio, the money that's coming back in. And it's currently only 54%. You can see it dropped way down from 158%. Only 765 million shares outstanding. And as a lot of utility companies can tend to do, they issue shares to bring in more money to plow into projects, which makes them bigger and brings back more revenue for us, the shareholders or business owners, as I like to say. And again, a lot of these numbers are going to change because we don't have the numbers that are reflected yet after the divestiture of the UK utility operations, as I understand it. So this is a company we'll have to revisit later on in the year. But Alpha Spread does have their share price at about 15% below their intrinsic value. And last we have Intel. Now this is a company that I have been buying. I'm really starting to build a healthy position in Intel because I really like, as I've talked about in previous videos, what Pat Gelsinger is doing with the company. They're turning around. He's trying to make them the preeminent chip producer and chip manufacturer, not just in the United States, but he wants them to really compete with Taiwan Semiconductor, which currently produces about 90% of the world's chips. So he wants to really start eating into TSMC's chip production. And we saw news with NVIDIA that is thinking about going with Intel, using some of their foundries to produce some of their chips. Now, Intel's all over the tech space, and check it out. If we click on products, there is just too many. But look at this one that just popped up, which, check it out. I think this is really cool that we just learned together that Intel is into the drone light shows. And if you're not familiar, check this out. The St. Patrick's Festival in Dublin, Ireland. That is just awesome. Let's watch this for a second. Check that out, what they did with their drones, putting on a light show for all to see. I think this is just so cool what Intel is a part of, and they are just all over the world. How awesome is that? Way to go, Intel. So Simply Safe Dividends gives them a dividend safety score of 80, dividend yield of 3.11%. Now, this is why I have been buying them. Average dividend growth, only 5% in January of 2022. Now, do know that they were downgraded by Simply Safe Dividends in February from 96, which was very safe, to still safe, but that's because they're going to be investing so much money into building all the chip foundries and really turning the company around, which would hopefully be a step in the right direction to put them as one of the world's preeminent and dominant chip manufacturers. They've been paying that dividend uninterrupted for 23 years, and it has been growing for 7 years currently. 36.5 cents per share per quarter. Check it out. That dividend yield of 3.11% is about 23% above their 5-year average of 2.51%. Their forward PE is also slightly above their 5-year average, but they are buried to the left of their 52-week price range. And their PE of 13.4 is also well below the infotech sector of 18.7. Now, their free cash flow payout ratio does seem a little bit high at 58%, but that's because they are going to be dumping so much money into turning the company around. But I still think, and I agree with Simply Safe Dividends, that they should have no problem continuing to pay that as long as we stay below 70%. And this is what some of the concern is, that their sales growth has been lagging, but the total sales is still up and to the right, as is their shares outstanding is dropping down from 5.16 billion in 2012 to 4.09 billion 10 years later. The return on invested capital, very solid at 16%. They do not have a lot of debt. And again, as we've touched on before, they can easily cover the interest on the debt with $36.99 of operating income for every $1 of interest expense. And Alpha Spread currently has Intel has 16% below the intrinsic value. Hey, we'd love to know what your favorite stock of these is, or if you're invested in any. We'd also like to know what is your favorite dividend stock that's currently below $50. So share your comments in the comments below, because you know where the comments go. And if you'd like to hear me explain why I think that AT&T's dividend is going to be perfectly safe after the spinoff, then click this video, the little box next to my head, and I will talk to you there.